Starting fresh in 2026, Billy, if we were to sort of start trying to map out a bit of a calendar, how would you go about approaching 2026 from a financial standpoint? A lot of different things you could be looking at addressing. Where do I start? What's some basics that you could do to try and map out how 2026 might look from a financial standpoint?
This would work for some people, and we know with clients, like when we're doing cash flow plans and things like that, some people work really well with structure and a spreadsheet and the system, and they'll follow it if they have that mapped out. Other people, that just doesn't work. But if you are one of those, and in a couple, often it's one person that works for one person and not the other person, you could certainly map out a calendar for the year where each month or each quarter you are ticking off 3 or 4 things in relation to your finances. And if you stuck to that throughout the year, that would be quite valuable.
All right, welcome back to the Winners Playbook. Josh here with Billy. This one is about turning good intentions into habits that you can keep. We're going to be keeping it simple today. A money calendar for the year, a savings rule you will not quit, and an investment routine that runs in the background while you get on with life. But before we dive into the topic, as always, Billy, we'll just have a bit of a chat about what's been going on in life. And we're closing in on Christmas, of course. Got one more week to go before the office shuts. What's the latest on your side?
What's going on? Well, hectic December as always. Last week I went to a music festival. It's the first time I've done that in a while, so that was interesting.
How'd that pan out? How'd that go?
Yeah, it was good. It was good. It was at Flemington Racecourse. It was like metal bands and punk bands and just some random other bands. The drama that happened, a band called 𝗕𝗶𝗹𝗆, who were big in
𝗕𝗶𝗆, what a name.
Do you not know of 𝗕𝗶𝗆?
No, I've never done.
You might know some of the hits. Anyway, the singer, her name's Shirley Manson, and we were sort of half watching, just talking amongst ourselves, and then she started going on this rant and attacking this guy in the audience.
Really?
And she was like, "Who do you think you are? You've got a small dick," and all this stuff, like ripping into this guy because he blew up a beach ball and was going to throw it into the crowd.
Are you kidding?
Like, that's what triggered her rant.
Wow.
And she ripped into this guy and said, I encourage everyone to go and bash up this guy, right?
Wow, that's a bit much.
Yeah, but like, Jesus Christ, like, we thought she was joking at first. She wasn't. She was like legitimately getting really angry.
Wow.
And then after that, then it was all in the media, all over social media and all this stuff. And it turned out the guy didn't do anything wrong. He was like this big 𝗕𝗶𝗆 fan who's been like going to their gigs for 30 years and all this stuff.
Wow.
And he just had a beach ball, which happens at music festivals in Australia. People bouncing around the crowd and stuff. Anyway, classic Australians, like 2 days later, the festival's in Brisbane.
Full of beach balls.
30 beach balls. Yeah. The crowd, there's like pool toys, like little blow up alligators floating, everything like that. As soon as she started, they all shot up in the air. They're bouncing around everywhere.
That's fine.
And she knew better than to say anything, but you could see she was just not happy.
That's funny. Well, she should be a security guard at like the test cricket, because they throw a few beach balls around the crowd and the security guards try to get hold of them and put them down. So she should be a security guard at the test cricket, I reckon. So she might do well if she's got a hate for beach balls.
I know. Yeah. And then she basically said, "I'm not coming back to Australia." Like just cracked it over this one beach ball. So it was quite
maybe some deeper problems there.
I think so.
There could be some deeper problems.
This is a 58-year-old woman, by the way.
Oh yeah.
Yeah, very, very odd behaviour. But the crowd had fun anyway, especially in Brisbane. So.
Yeah, no kidding. Wow. That's that's different. Anything else on your side as we approach end of year?
No, nothing else too exciting. How about yourself?
I just got back from Tassie last night, so that was good. I was down there seeing our team for the week. So just getting down there and amongst it with Dan, the advisor, the head advisor down there, and some of the new staff that have joined, and just thinking about what the big plans are for 2026. That was good. Weather was okay as well. And just got back last night and just, lots going on towards the end of the year. We're obviously closing next Friday. We'll do our sort of big end of year presentation and reflection on the year that's been with all of the businesses, talk about the ups and the downs. And then, try and switch off for a couple of weeks, which I never really do well. Being better at, I think. It's always a hard one, but I think, yeah, at least naturally clients aren't engaging as much and there's not really much happening over the break. So it does allow you to sort of try and switch off a little bit. So that was good. But as long as I keep myself, or that will be good, but as long as I can keep myself busy, I think I'll be all right. My tomato plantation's booming in the backyard.
It's like a plantation.
It's going well. I got home like a bit late last night, and so I went out this morning after a little work. And I was like, I got to go check out the tomatoes before anything here and see what's going on. And there's a few coming out. There's a few growing nicely. I've got about 15 plants growing out there. So I think I spotted maybe a little 15 cherry tomatoes on the go there. And yeah, been watching plenty of videos online on little tips on how to get them going. I actually seen one video where you like pollinate them by when the flowers start coming out. You get an electric toothbrush and you sort of put it on the back of the flower. It sort of it gets it going, and it will sort of self-pollinate in a way, I think. Anyway, I might give that a crack a little bit later today. Once I finish up, I might be out in the tomato plantation with a little toothbrush. I'm giving it a bit of a vibration on the back. We'll see how we go. I don't know. It's fun though. It's definitely fun. So off 15 plants, I should get a decent amount. So there might be some cherry tomatoes flying around the office next year for whoever wants them, because I could get a decent yield off them. We'll see. I won't get my hopes.
Somebody make some tomato chutney or something. What do you?
Oh yeah, anything. Well, we use a lot of tomatoes though in the house, because we eat a lot of curries, and my wife's got like she's Mauritian background, and they have a lot of curries, and a lot of them are tomato is like the base. So we'll use a lot of them, but then you can just freeze them as well and just sort of hold on to them and use them when you need. So anyway, I won't get my hopes up, because there's plenty of things that could go wrong. Maybe some pests could come through and just destroy my dreams as well. So we'll wait and see how we go. But yeah, nevertheless, obviously today's topic's a good one, because end of year, everyone's really hanging to get to the finish line, and then think about I don't know how what's your relationship with the end of the year, Billy, and just like fresh starts. And yeah, I don't know. I've got a bit of a mixed feeling about that, and people, holding off and then thinking, well, 2026 is going to be my year. Like, is that really going to change if you don't address things maybe going deeper down in your life? I think people sometimes use it as in a way, as a good thing. Like, sure, it is a fresh start, but, so I see so many people get so quickly back into the same habits, and then they just fall back into the same routine. Nothing actually changes. What are your thoughts on the whole, New Year's resolution, and what have you seen over the years with that?
Yeah, you can definitely set yourself up for disappointment. Like,
Yeah.
like I'm gonna stop doing this bad habit. I'm gonna start doing this. Obviously, the classic one is, I'm gonna start going to the gym every week and all this stuff. And you're just setting yourself up for failure, I think, if you think you're just gonna magically change all your habits just because it's a new calendar year. Personally, the only thing that I've found is that, particularly the work-related goals, like if you have 2 or 3 things that you're like, next year I want to achieve this and tick these 2 things off.
Yeah,
I've found that and then you fixate on that. I have found you can tick those things off.
Yeah.
In terms of personal goals, yeah, changing like daily habits is not something you can just flick a switch on. So I don't think that's particularly helpful. I think it's more just those 2 or 3 things, or like one big change, like, we're going to move house, or I'm going to change jobs, or like ticking off a couple of big things is useful to try and have that as a goal. But changing your daily habits is, we've read books about it and stuff, right? It's like changing habits is like minor adjustments, not really like, starting on 1st of January, I'm going to do this. Like, that doesn't tend to work.
No, it's yeah, like you're trying to rip the Band-Aid off there, and it's, I don't think so. Like, you don't need a fresh year to start. And if you're thinking that going into a new year is going to completely change your mindset when you've never been in the habit anyway, like, sure, you could last through the first couple of months when, weather's good and everyone's up and about. But then when those winter months set in and it starts to get a little bit more grim, it's a bit harder to get out of bed. I'm talking, like going to gym and things, which is what a lot of people think about, starting fresh on. It very quickly fades out. So yeah, I think there's some good things to look at there as well. Like having someone to hold you accountable is a good one there. Because if you're not great at holding yourself accountable, which a lot of people actually naturally aren't, then get someone or a friend, or don't go at it alone. Have someone there that can actually hold you accountable and be real with it. Because if I've seen people that I want to quit smoking or whatever it may be, and they're like, oh, I'll wait till the holiday season's over though. So when I go back to work in the mid of Jan or whatever it may be, and nothing ever changes. So yeah, sure. 2026 it is a time to start fresh, but I think you got to get real with it as well. But today we'll obviously talk a bit more about the financial side of things, but it does actually correlate into all of what we were talking about there. But starting fresh in 2026, Billy, if we were to sort of start trying to map out a bit of a calendar, how would you go about approaching 2026 from a financial standpoint? A lot of different things you could be looking at addressing. Where do I start? What's some basics that you could do to try and map out how 2026 might look from a financial standpoint?
Yeah, I mean, this will work for some people. And we know with clients, like when we're doing cash flow plans and things like that, some people work really well with structure and a spreadsheet and a system, and they'll follow it if they have that mapped out. Other people, that just doesn't work. But if you are one of those, and in a couple, often it's one person that works for one person and not the other person. So you could certainly map out a calendar for the year where each month or each quarter you are ticking off 3 or 4 things in relation to your finances. And if you stuck to that throughout the year, that would be quite valuable. So we've built a little bit of a calendar here using our friend ChatGPT, of course, and then making some edits.
Of course.
It went a bit overboard. I think it had like 30 things on it, and I thought, oh, that's really excessive. So I've dumbed it down a bit, or like simplified it. So Q1, we've got review your super and the investment options within it. For most people, you don't, if you're young, you pretty much just want to be in a high growth, aggressive style option. So I'd say you probably don't need to do that every year unless you're like approaching retirement or something. Make sure your beneficiaries are done. It's got set annual savings target. I think that's more update your cash flow plan and your budget plan. What's your view? I think that should be done once or twice a year.
Yeah, I try to do like a
Yeah.
big one at the beginning of the year and try to look over all of the numbers is always good. And that was a part of what I was going to mention as well, like reviewing the budget, particularly the direct debits. Like sometimes you forget certain things that are happening there in the background. So I think going through, looking on all of that, reviewing insurances and things and holding your providers accountable is always a big one. Sometimes that does get a little bit out of whack. So you definitely have to keep them honest, but that's always a really big one, is just reviewing that budget. Because then with that, you can at least set plans around holidays and being deliberate about it, not like reactive. I see so many people operate like that with holidays. I just see them and nothing's planned, and then like catch up with them 6 months later and like, oh yeah, we shot off over here and did there, and like it wasn't really planned, and they probably paid a more expensive dollar in terms of the cost of those flights as well, because they weren't booking them in advance. So I think, yeah, the cash flow one and budget one's a big one. And sure, if you can do a reconciliation throughout the year as well, easier said than done, though, I would say.
Yeah, well, I think those are good ones to do at the start of the year, because it is a bit grim if you try and set up a really strict structure and then you buy 1,000 Christmas presents and take a couple of weeks off work, and then it's going to be pretty tough to it's going to be pretty tough to stick within tight limits through that period. So yeah, that's not a bad one to do in January. It's got Q2 end of year super contributions, of course. Assess if you've got the money to do that. You can save a bunch of tax. So that's something we do with all our clients around sort of April, May, June. Life insurance, yeah, that should be reviewed once a year. I think we do that for all our clients. And if you're doing it yourself, do it yourself.
Yeah.
Q3 update cash flow plan. So I think that's good. Yeah, do that during the year as well. Review your investments and rebalance if needed. We'll come back to the investments. I think we've got a point on that coming up.
Yeah.
Check your interest rates. So you want to have a good mortgage broker, of course, for your home loans. So it might just be a quick message to them. Hey, have I got a good rate here? Do we need to make changes?
You want to touch on that one, Billy? Obviously lots changed with interest rates in the last couple of weeks, and what 2026 is now looking like. It was all rate cut talk, and now it's rate rise talk. Do you want to touch a bit on that?
It's so silly, and as usual, the media blows everything completely out of proportion. And the Reserve Bank, the RBA, gets trapped in this as well. They're sort of like, a couple of months ago, they're like, yeah, there's rate cuts. We're looking at rate cuts. Yeah. In 1 week, it changes. Like one inflation piece of data, and they're like, there's no rate cuts, we might have to increase. In January they could be talking rate cuts again. So it's just silly. But what should you shouldn't worry about that too much. You should really just be making sure that you're not giving the bank more interest than you need to. So it's just review your home loans. Because as we know, loyalty is punished when it comes to the banks. If you don't change banks, they'll often just sneak those rates up on you.
For sure. Yeah. And it's actually a good point. I'm doing a bit of a refinance with the broking team internally at the moment with some loans. And because one of the properties I purchased a couple of years ago, I did it on a 88% LVR because I didn't want to put in a full 20% deposit down on it. And because of that, I had a higher interest rate than if I did a full 20% deposit on that property. But now the property's actually grown a lot over that short period of time. And so I'm reviewing it and doing a refinance just purely to get a lower interest rate because it was on a higher LVR loan, and therefore it's a bit more risky for the banks, and they charge a bit more by way of interest. So, there's a lot of people that probably would have bought properties and have purchased properties in a similar situation, not necessarily always putting down a 20% deposit. So there's a lot of little easy wins that you can look at when you start looking at your loans and refinancing those. So yeah, good point, Billy.
Yeah, and that's a really good point on the loan to value ratio, the LVR, because I know with my house we were above that 80% as well, so we didn't have the best rate initially. And this is something a lot of people don't know. You can talk to your mortgage broker; they can get 3 different banks to give you a valuation on your property. When we did it, there was wild differences in the valuations. Like I think one bank had it at 980K, another bank had it at 1.12.
Yeah, massive.
So the bank that's saying your house is supposedly worth 1.12, that's going to mean your loan to value ratio is lower. If you go refinance with them, they're going to give you their best rate.
Yeah.
And that's what you don't get if you just like, I deal with Commonwealth Bank and that's it. Like if you just stick with one bank, you won't get the benefit of that.
Yeah.
So the mortgage rate's a good one. Definitely do that once a year. And then the last piece has got Q4 Christmas budget and holiday spending guardrails.
That sounds pretty sensible.
It's a little bit too sensible maybe, but yeah. And then this is one I added in a year in review. I do, and we do this like at our work thing next Friday. We'll do this. All right, let's look back over the year. Like pat yourself on the back if you ticked off some good wins and you achieve something you wanted to achieve for the year. Like it's not all about being hard on yourself and reining and spending and all that stuff. Like congratulate yourself if you tick something off that you wanted to do. Reflect on the year and then goal setting for the next year.
Yeah, and one thing you can actually do is I think the best thing you can do, like particularly if you've got kids as well, is actually schedule in some time and go to a coffee shop or go somewhere with your spouse, or even if it's yourself, just maybe you do it with a friend. And early January, take some time. I've done it over the last couple of years every year, and go through and go, hey, like what do we want to achieve? Of course, if you've got an advisor, you can do it with an advisor. But if you don't, or even if you do have an advisor, maybe do it yourself first before you see your advisor, and then just get out of the house, get away from the kids if you've got kids, and just take an hour or two and seriously think about what do you want to do over the 12 months and, break it down into like the fun stuff. So, all right, where do we want to go on holiday? We want to go to Japan or whatever it may be. How much is that going to cost? And like loosely plan for it, but like put those 12-month goals down and agree upon it together. Because I find sometimes as well with relationships, one person tends to take the lead and then the other person kind of just sort of, follows along. It just doesn't really get involved. But, and that's definitely quite relevant for me. But one thing I've done with my wife Alana in the last couple of years is get her a lot more involved. And 2 years ago, I think we went into our office early January and we sat in the boardroom and I'm like whiteboarding everything out. I'm like, let's look at it. Like, what are we going to do? What are we going to do? And then last year, I actually had someone do it with me. Another advisor actually do it with me, a good friend of mine. We went into his office and then we went through it and that, and it was really good because then I had someone else stress testing my thinking. So I think that's a really good one to look at doing, is just get out of the house, spend a couple of hours and just like take time out of your busy lives to think about what you truly want to get out of 2026. And maybe it is starting investing, starting on a small basis, whatever it may be, but just, break down those areas like with the family, personal, business, or if you're working for a business, do you want to upgrade your role, some studies, so many different ways, but just actually scheduling the time, you would be surprised at what comes out of that. So I think that's a one I would add to it. And then going on from there, it's because we're going to talk a bit more about the investment side of things, but what, like a savings rule, I've got a thought on my own savings rule, I would say, but what would be your savings rule? How do you set a savings rule in place for 2026? Life's getting busy. What would you say, Billy?
Yeah, I mean, there's a few you can use here, but one thing I like is, and I've spoken about this before, like purchases above a certain level is where you don't be spontaneous. Like it might be $50 or $100. Like it's under that, blows away, right? Your day-to-day spending. But anything over $100, you sleep on it. Something like that. Because that's where you can get carried away, especially if you're just doom scrolling Amazon or something. So not being spur of the moment on big spends, and at least sleeping on it or speaking to your partner before you do it.
Yep. Very sensible. Mine's probably a little bit more harsh.
It's classic.
Mine's just simply put a personal tax on yourself. I speak about it a lot. And, if the government put up taxes next year, people would kick and scream, but you just pay the tax. You seriously can't do anything about it. And you would learn to live off more or adjust your lifestyle, and you'd figure out a way to survive, or maybe it would motivate you to earn more. I don't know, but put a personal tax on yourself. Now it sounds bad, but it's actually not. But think about, okay, whatever amount of money you're earning, and then if even go on the low end, take 5% of whatever that figure would be. So whatever you're getting in your net pay, if you earn $1,000 a week after tax, or 2,000 or whatever it is, and take 5% of that and just push it to a separate account. To go one step further than that, then that's where you'd push it to an investment account as well to really get it out of sight. But put a personal tax on yourself, because again, if the government put up taxes next year, and they can always change the tax rates, I'm sure they will change in future. They've been lowering the last couple of years, or getting a bit more favorable. But yeah, if you put a personal tax on yourself, you will learn to live off less, and you will adjust your lifestyle accordingly, and you'd be pleasantly surprised at how well you might actually do. So think about that, putting a personal tax on yourself. That could be, a lower amount, 0 to 5%. That could be 10, 20 or 30 or 40 or 50, even more than that, depending upon your situation. Like if you live at home and you live with your parents, and you've got your first job or whatever, it's not unrealistic for you to save 80 or 90% of what you earn. Like not unrealistic. If you're not paying much rent or anything of sorts, your bills are relatively low. So have a think about that personal tax on yourself. And then it's more importantly around where that money then goes, because you might want to get that out of sight, because if it sits in your savings account, it might be quite easy for, like you said, Billy, not having a cap on what you spend. Oh, I'm building up some money now. I've got $1,000. Well, cool. I've earned it. Let's go out and spend that money. So that's where you might want to separate it over to an investment account and, get that out of sight, which is going to go into the next question I was actually going to ask is, the cleanest way to automate investing without really overthinking it. What are your thoughts there?
Well, you just want to remove the regular decision making. Like you don't want to be looking at your investments every day. You don't want to make decisions on what to buy and sell. You don't want to make decisions around how much to invest. So you just want a direct debit, in line with your pay cycle or your cash flow plan. You want a regular direct debit. You review that once or twice a year. It goes into an investment account where the portfolio is preset, so you're not making decisions. It's all automated. You don't have to think about it.
Yeah,
that's it.
Yeah, out of sight, out of mind. And I've had a couple of clients I caught up with recently who, earning really, really good money, but seriously, if the money stays in their savings account, they will spend it. So they were honest with it. They said, Josh, if this sits in our account, like we're just going to spend it. So they were already investing a lot of money every month, like just automated. But then we actually decided to the savings component, because generally when we work with clients, we don't have them investing like every single surplus dollar they have. Generally, they're going to save some money and have a bit of a surplus like that. But for these clients, they just said, look, if you keep it in our savings or offset account, it's going. So we, as an example, the figure I think was about $10,000 a month that they invest. Like they earn good money, but then they were supposed to be saving, I think, about like $3,000 or $4,000 a month. But they weren't saving the 3 or 4 because it was sitting in their savings account. So what we ended up doing is with the automated investment, we actually increased that automated investment to say $14,000 a month. But when it was going into their investment account, only $10,000 was investing automatically. $4,000 was actually pooling in cash. and still getting a decent rate of interest on it. And sure, it's not sitting against a mortgage or in an offset, but in that situation, they would have just spent it if it was in their offset account. So getting it actually into it. Yeah, getting it into the savings account where it's like, it's a bit more out of sight. Sure, they can access it at any point in time, but it's not as simple as, log into my ING or my ANZ and, there's some money, transfer it over. There's like a bit of an extra step to it, which stops people from doing it.
Well, Lou, the extra step is Josh Lee judging you as a gatekeeper on the investment account.
Too true. Like, I feel that's like,
I got a few clients like that too. They know they'll be ashamed if they reach out and say, you know how I said I was going to say invest this money, I need it back.
That's so funny. I guarantee some clients that goes through their head as like, all right, I have to email Josh here to say, hey, how do I get money out of the account? And it's like, no, let's just not do it. I'm sure there is clients that are like that. So is that a good or a bad thing? I don't know. I'm going to say a good thing.
Well, let's be clear to anyone listening. We're not gatekeeping the money. Our clients can contact the investment.
Exactly.
They can access the investment account themselves and do a withdrawal.
Exactly.
But usually they do it through us because we're advising them. But that would definitely be a bit off-putting if you go, shit, we got to tell Josh we need take some money out here.
Yeah, well, I think in a way sometimes as well,
even subconsciously, right? Even subconsciously, yeah.
Yeah. And I think they just sometimes need confirmation as well. Like, maybe they want to be told like, no, don't do it, or that's wrong, or, it's okay to do it. I think sometimes there is a little, like they want a bit of reconfirmation.
Yeah.
And, you can't, like you said, we can't ever stop a client taking money out. So as much as I've had clients sometimes come through and say, hey, I want to pull it out, I'm like, oh, well, we just caught up and this and that. And, we spoke about not touching any investments because you were doing this. But it's like, hey, if you want to pull your account out and you want to pay a bit of tax on your investments because they've grown in value, it's your choice. We'll facilitate it. But, I think that extra step does go a long way.
100%. Sometimes it's legit. Yeah, medical costs, something's come up, and you just go, yep, no problem. We'll get the money as quickly as possible.
Yeah.
But if they're just going to blow it on shit, then there might be a little bit of judgment going on.
No judgment, of course. What about if we reverse and look at the other side of the equation? So we're talking a bit about investments there. What if we look at the other side with debts? What's your approach there on, attacking debts? You might have a car loan. I don't see too many people these days with a big credit card debts. I don't know about you, Billy. I'm most 9 out of 10 clients I see with credit cards use them sensibly. And well, okay, use them sensibly is probably not the right way to say it. They don't have a big 10 or 15K debt and they're incurring interest on it. They probably spend more than they would if they didn't use the credit card, but they pay it always before the interest period comes to an end, or the interest-free period comes to an end. So, yeah, what's your approach with debts? If people have got some debts, maybe a little car loan here, maybe there is a bit of a credit card debt, personal loan, throw a mortgage in there. They're the common ones that we're generally going to be seeing. How would you approach it?
Yeah, there's two components. One is the consolidation thing. If you've got lots of different debts, then it will certainly help you gain control if you consolidate a bunch of those into one loan. So you've just got one payment and you can see that loan being paid down. So there's the consolidation piece. And then the second one is, if you've got multiple debts, which one should we pay off? A small debt, like if there's a personal loan that's got 2 years worth of repayments left on it, but we figure out we can actually pay that off in 6 months instead of 2 years, that gives you a psychological win. It makes you feel good and makes you feel like, all right, now I'm on top of this. Now I can tackle the next debt. So consolidation and then paying off the smallest. Whatever you can pay off the quickest is usually good to tackle that first.
Yeah, I think it's a good point because people usually think the higher interest rate one could be the way to go, but that could be a 60, 70K car loan and then you're chipping away at that thing for a while, whereas...
When you lose hope, right? And you give up.
Yeah,
so you want to get some wins on the board, get some confidence back and realize there's a light at the end of the tunnel. So if you can pay one off completely in a short time frame, that's pretty good.
Yeah, the brain needs that little dopamine hit. Yeah, got to get rid of one. Got to get rid of one. So there's plenty to be said in that. And I think the other thing to consider as well is when you're doing those debt consolidations or you're breaking some other loans and trying to get out of them, just look at if there's any break fees on them as well. Sometimes there can be early repayment fees and payout figures, because the bank wants to get their interest and so on. So you got to look at that, particularly around cars if you're going to be paying them off in advance. Now, we touched a little bit on insurance super beneficiaries. So, obviously if you have an advisor, they're going to be doing every single one of those things for you. But in the terms of the quick checks on some of those things, I was going to mention also like the car, the health insurance, and keeping them honest. That's always a good one. But yeah, with regards to those, Billy, I think were they the Q1? Were they the Q1 ChatGPT recommendations? Were they?
Yeah, I don't know why I'd had it at the start of the year. But I guess like super contributions are part of your cash flow plan. So that's a good one to do at the start of the year. With the life insurance, that's a once a year check-in, I think.
Yeah.
If you need a lot, like if you've got little kids, big mortgage, school fees, all this stuff, like you need a lot of insurance, definitely use an advisor, because it's no good trying to DIY that unless you really, really don't mind building a big spreadsheet and looking at product disclosure statements and stuff.
Yeah.
So if you need a lot of insurance, use an advisor. If your needs are simple, you might just set something up through your super fund. But I think that should be once a year. First thing is, how much do I need? Second one is, what will it cost? And then what's the trade-offs here? Like, what's a reasonable amount to spend on insurance? Because obviously the more you spend, the less money you're going to have for investing and so on.
Yeah. Worth noting with the insurance as well, most people, if they've never looked at it, they're just going to have a default level of cover in their fund as well. And that's generally, I've never seen it actually be appropriate for a client situation ever. Either one, it's too little for what they ultimately need, or it's going to be too much and they don't even need it. Like I've never seen that default cover ever actually suit someone's situation. The income protection's never in line with their salary, small levels of life or total disability, or too much because of their age. So very, very much a good one to check off in the early part of the year is what that insurance is. Because if you've got the insurance in your super fund as well, you're paying for all that from your retirement savings. So you actually are paying those insurance premiums from your superannuation fund. And then the beneficiaries as well is always worthy of looking at. I forget the stats, but I think it's about 50 to 60% of people, like the beneficiaries aren't actually updated on their superannuation fund, or they may not even have a beneficiary nominated on their super fund, which means they basically leaving it to the super fund to decide and figure out where their money should be paid. Now, there's obviously a way that they work that out. It's not going to get paid to, your neighbor or anything like that, unless your neighbor's your spouse. That's a little bit different, but there's a way that they work it out. But there's so many little things there that people just generally tend to neglect and don't look at that if you can check in on them, and particularly with some funds like industry funds as well, beneficiaries are not non-binding. They lapse every 3 years. So they go from a binding nomination to a non-binding nomination after a 3-year period of time. So it's worthy of just checking on that one, because if your 3 years is up, you might want to just convert it back to a binding, and it has to be witnessed and signed off again to make it happen like that. Whereas a lot of the funds that we actually recommend, they provide non-lapsing options, so you just do it once and you never have to worry about it again. But each to their own. And if we bring it to a close, Billy, on one habit to drop in a new year that will save you time and money, curious to see what you've got on that one.
Yeah, I was thinking about this a bit. What's one habit? It's not a practical thing. It is being very aware of comparing yourself to others and the lifestyle creep component. Like I went to a private school. If I look at my friends, it's like, yeah, they're going to Europe, they're buying big houses, they got nice cars, so all that private school, all that stuff. And it is just so unuseful to even think about what other people are doing and the decisions they're making with their money. It's completely unhelpful. And we know, a lot of people don't see this, but we know people in that sort of cohort with those lifestyles, a lot of the time their finances are not in good shape, or they've got parents that are dishing out cash to them. So if you're sitting there thinking, how come all my friends get to do this and we can't afford it? There's just no point in obsessing over that. Just worry about your household and your decisions and what's important to you and what you value and what you can afford to do.
Yeah, that's a really good one. And I think a lot to be said in that, because there's very, very much in today's society where you can get hold of a lot of debt, and sometimes it makes things look better than they actually are. But it's kind of like beneath the surface is a little bit rotten. It's kind of like if I can plant some tomatoes on a poor patch of dirt, it might look good for a period of time, but underneath the surface, the soil's not too not too nutritious maybe for those tomatoes, and they'll rot and not produce the best yields and last longer term.
Exactly. Well, if we're doing analogies, Shirley Manson shouldn't have worried about that guy at the beef ball. He was just having fun in his own way. And she should have respected that. So
yeah, too true. No, that's good. Well, mine's similar in a bit of a way, but I had the victim's mindset one of, really, really owning your 2026 and not putting the blame on others and, worrying about what the government's doing and, where are interest rates going? Because all of those factors, which I call like more of the macro, like you cannot control any one of those factors whatsoever. Like what happens out there, you have virtually no control over any of that, and really nothing changes if nothing changes. So you got to really take personal responsibility and accountability in 2026 on your life and realize it's like up to you. Like I truly believe, and not everyone believes it, but I believe you can do whatever you want in life, and you can change your life any day if you want to make the decision to be able to do it. But yeah, realize only you can make that decision for you. And yeah, if you want to make 2026 a big year, you can do it. So if you're in a position where you don't resonate with that mindset, that's where you might want to get around people that have a similar sort of a mindset, and that will start changing your life big time. The people you hang around with have a massive impact on how you feel and your prospect and how you naturally look at life. So if that's not built into you internally, or it's not a habit you kind of resonate or associate with at this point in time, try and get around other people who are like that. And that's probably one of the biggest hacks to success or getting anything that you want in life is, find someone who's done whatever you want to do or is wherever you want to be. And that doesn't even mean money. It could be literally anything, and just try and get around them, or maybe just reach out and see if they might be up for a chat. And you might be pleasantly surprised that they'll be willing to chat with you. So in saying that, Billy, we might bring it to a close, and I think we might try and squeeze in one more podcast before the end of the year. We do have another week ahead. We might, I'm thinking next week we might do a bit of a reflection on the year and the highs and the lows. Maybe what was the highlight? What's the low light in there? We might do a bit of a reflection in next week's podcast if we can make time for it. But nevertheless, I hope everyone that is listening is getting something out of it. And if you are, 5 stars on Spotify and Apple. We are going to be back next year with a big revamp on the podcast when we get into our new office, which is probably going to be around late February at this point in time. We're doing it.
Yes, I don't get too excited for January. It might be a little bit later than you, but
yeah, it's going to be awesome when we get into the new office. Got the new podcast set up in there. We're going to really take things to the next level. But nevertheless, it's been a good year. We'll try and squeeze in one more podcast. And yeah, if anyone, of course, is wanting to chat, as always, jump on the website, take a pick from any of the advisors in the business, or reach out to an advisor that you might have seen online and maybe have a chat about what 2026 might look like for you, or maybe how they can help you in setting out your goals and your objectives. But until next week, Billy, we'll leave it there, and I'll see you then, mate.
Thanks, Josh. See ya.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.